Welcome traders to episode 2 of the free YouTube course by your favorite mentor, Wolfpack Take Profit. Now today we're going to go through a few key concepts, but the first is how to never blow your funded account ever again, or any account for that matter. And now, as a student of mine, I want you to know that the number one rule is to preserve capital. I know you want to make a lot of profit, but you can't make profit without having capital to allocate. If you blow accounts and you just run accounts down the whole time, you can never profit or be a long-term trader. So remember that number one rule: preserve capital, not generate profit. That comes with allocating capital effectively whilst managing risk. And today I'm going to show you how to do that. So let's imagine you're trader A here. Now trader A has been working really hard. He's saved up $10,000 and now he thinks, right, I want to jump into the market. I'm sick of my job. He's still working, but he wants to trade and find a way out. So he's watched a few YouTube videos and he's figured he's going to risk 2%, and he encounters a loss streak. Everyone has. I have. Any mentor that you followed has experienced loss streaks, and it does happen. Now this example, he goes on a 10 loss streak, and here we have the number of trades, here we have the account equity, and he starts off and he loses his first trade and his account goes down to $9,800, and then second trade loses $9,604, so on and so forth until he gets to the 10th trade. On the 10th trade, his account equity is at $8,170.73, which is a total account drawdown of 18.3%. Now that is a lot of capital to lose, let's say in a time frame of 2 months. So he's saved up for 2 years, got his $10,000, and he's already down 20% or close to 20% in 2 months. This is the point where I'm going to introduce you to mental capital. Now, after trader A deposits $10,000 into a brokerage account, in those 2 months, these 10 trades time frame, his mental capital was only $1,000. So what does that mean? All the way up until this 5th trade, he's within that mental capital range. So his mental capital is still intact here because he's below that $1,000 within the 2 months. He doesn't know what his mental capital is, but you will be able to tell what your mental capital is when your emotions start to kick in, and that's how we tell what your mental capital is before your account's capital is diminished. So once he gets to here, he's pretty nervous, but he's still hopeful that he can make money with it. On this next trade, when he dips down below and that figure drops from 9 to 8, his mental capital has been spent, and the way that you'll know that, you'll feel anxious to enter, he'll feel anxious in the trades, he might be tapping his leg loads while he's in the trades, he might be pacing around the room, he's just hoping, watching every 1 minute candle with nothing more than hope that it's going to go his direction. This is the point where mental capital has been spent. Now his ability to make a sound decision after this 5th trade here, and he gets into these 6, 7, 8, 9, 10th trades, is obsolete. He can no longer make a sound, logical decision because his mental capital's been spent. He's not thinking clearly, his hands are sweating, he's pacing around the room, he's anxious, he's fearful, when he gets into a bit of profit, he's feeling greedy. This is when you know mental capital has been spent. Now, trader A listens to his favorite mentor, Wolfpack Take Profit, and he's been given the shield. His equity, again, is $10,000. He's got the 2% risk, but he's got his shield with him. He experiences a 10 loss streak, but the breakdown of his capital goes: trade 1, he loses his 2%, and then he drops to $9,800. Trade 2, $9,702, so on and so forth, so on and so forth, and then he gets to the 10th trade and his account is at $9,320.64. He still lost 10 trades, but his drawdown is only 6.8%. Keep in mind, that's still within his mental capital. His mental capital for these 2 months of trading is 10%. So he's still in he's good mental pace. He doesn't feel anxious going into the charts because he's taken 10 losses and he's still within his mental capital range. How do you do that? Well, that's exactly what I'm going to go into now. But let's just remember that his mental capital's been spent, trader A, but trader A with the shield, his mental capital has not been spent. So now I'm going to break down to you how we become this trader here with a shield, and this trader here can stay in the game for the long run. So this is how we do it, and this concept is what I'm going to call the shield. And now the shield is going to essentially stop you from ever blowing an account again. If you implement this and put it into your trading, you will never blow a funded account, you will never blow a live account without seriously fucking up or seriously deviating from this plan. And now, what this plan is after the first loss, reduce your risk by 50%. After your second loss, reduce risk by 50% again. And then successive trades stay at this risk. So what that means, for this example, we had trader A with his 2% risk, and he kept that constant, and as you saw, he had 18.3% drawdown. Trader A with his shield, after his first trade he lost and he was risking 2%, which brought him down to $9,800. And then on his second trade he only risked 1%, so after his first loss, reduced risk by 50%. As you can see right here, he had $9,702, whilst this trader had $9,604. He loses again, so on this trade now he's down to 0.5% risk, and then this right here delineates, it stays as that until he gets the risk is applied until 50% of previous drawdown barrier is achieved. So what that means is he continues whilst he's losing. So after this, so he loses the first trade, the second trade. On the third trade here, he's now risking 0.5%. Every trade he loses after that is on 0.5%. It doesn't keep dropping. It drops down to 0.5%, and look how easy his account can withstand 0.5% risk whilst he's still losing and taking losing trades. On the third trade he loses $50. Second trade, then he uses $48. On the fifth trade, as you can see, his account can withstand it, and that results in only 6.8% drawdown because he's still losing and his mental capital has stayed intact. This trader's mental capital got spent after the sixth trade. His mental capital was spent, and all of this money lost was just delusional money that he was just thrown into the market whilst his emotions had grabbed hold of him. This trader took 10 losses, but his mental capital has stayed intact, and that's all because of the shield. So if your risk is normally 1%, if you lose, drop it to 0.5%. If you lose again, drop it to 0.25%. Now, when does your risk start to climb back up the ladder? Think of this as a ladder. That's why I've got these annotations here to signify that you can jump to and from the ladder. But when you're taking losses and moving down the ladder, when do you move back up? So let's say in this example, you're risking 2% on $10,000 like these traders have been. The first trade you lose $200. Your equity is now $9,800. Your drawdown is $200. 50% of your drawdown is $100. Your risk is applied until 50% of previous drawdown barrier is achieved. So what that means is our drawdown is $200. We cannot jump after being dropped down to 1%. After taking this first loss, we cannot jump back up to 2% until we've at least made 50% of the drawdown back. So that would be after one trade. Your next trade you're risking 1%. Your second trade you win a 1 to 2. You make $196, risking 1% of this, and you make a 1 to 2. So you make 2% of this account, which is $196. That generates an equity of $9,996. But notice this $196 is greater than 50% of the drawdown you experienced. So what that means is you can now jump from being 1% risk back up the ladder, because you earned back 50% of the drawdown that you experienced. So your equity is now at $9,996, but your drawdown is only $4. So as you can see right here, I've got $196 is greater than $100, so climb back to 2% risk. And now this is the process that you're going to go through. If you lose 2 trades in a row and you get down to 0.5% risk or 0.25% risk, that continues until you earn back the half of the drawdown you've experienced all the way through trading this percentage. So if you had $1,000 account and you lost 2 trades and lost 3 more trades at 0.5% and you were down to $500, you have to trade 0.5% until you get back to $750. So your risk continues to be that until you get back 50% of the drawdown that you've experienced. And that doesn't mean you jump to here, you jump to 1% then at that point. Once you've got back half of your drawdown, you can jump the ladder. This way, you can actively and effectively manage your risk. And yes, I understand the math that I just used wasn't correct with the $1,000 example, but it's just purely an example so you can understand the system and the process. Now we're going to jump into talking about traders who have actually won some. That was previously talking about traders who have only ever gone on a losing streak and they've used the shield, and you saw the benefits there. Now I'm going to show you the benefits for a trader who's got a 40% win rate and a 2 RR, which is, I'd say, an industry average for a trader to try and achieve. So as you can see, this trader right here, his profit, these are the figures after one trade. This is the same on both sides. So this shows the trader's win rate. So he lost here, won here, lost, won. So it's the same on this side. So he lost the first trade, won the next trade, won the trade after that, lost this trade, lost the next trade, lost the next trade, lost the next trade, lost the next trade, and then won the last 2. So his profit ended up being 3.63% and his drawdown ended up being 4.19%. So as you can see, there's a differential between these 2 figures. The profit that he gained was less than the overall drawdown he experienced, and now that is what can ultimately cause drain on mental capital. So in the future, if he implements this system here with the shield, you can have a positive differential. Again, it's showing all the wins and losses and how the risk climbs from winning, then he lost, then he won the next 2, then he lost the next 5 in a row. So 1, 2, 3, 4, 5 trades lost. Sorry, 4 trades in a row lost. And then this one he was trading and won. Then he got to climb back up the ladder because he earned back 50% of the trades that he lost in this area here. So as you can see, he went down from $10,035 and then he went down to $9,935, which is $100 difference. Then from here to here, so 50% of that drawdown period in this section would be $50. In this area, the difference between these, $100. So we got to jump back up the ladder. He earned over 50% of the drawdown he experienced in this section. And then he got to jump back up from 0.5% risk to 1% risk. So that results in him having a positive mental capital differential, which is basically the difference between the drawdown the account experienced, which was here. This was the lowest point it ever got to on the first trade when he lost 2%, and then every trade after that he experienced, other than 3 trades, being in profit. So this trade, this trade, this trade, this trade, this trade, this trade, they're all in profit. And that's purely by using his shield to protect his capital. He only had to withstand 2% drawdown to get 2.36% drawdown back. Whereas this trader here, if he went on a long enough run, could end up blowing the money, or if you've got a funded account with like a daily loss limit or a maximum drawdown, your drawdown, you might have passed the account if you kept on trading, but your drawdown gets too big before you can pull it back. And that's exactly what this stops, and that's what I want you to start implementing when you're doing these funded account challenges, because you physically can't blow it if you start to implement a system like this. Over 10 trades, his max drawdown was 2%, and that's with a 40% win rate. That's so achievable. To maximally draw down 2% with a 40% win rate and a 2 RR is completely within the realms of possibility. So I want you to start to think about what you actually do in your trading. Normally the trader's natural inclination is to up their risk when they lose, and I've done it myself, and a couple of times it's worked and it feels great, but let me tell you, 99% of the fucking time you blow the account. And I know you think, oh, I've just lost 1%, so if I up it to 2% and then I get a 1 to 2, I'm actually going to be up 3%. But then lo and behold, you're up 2% floating, and then it reverses, and then boom, you're down 4% now, or you're down 5% because you've over leveraged. What I'm teaching you here is the number one rule of trading, and this won't attract a lot of you. I'm sure some people have already clicked off because it's just me talking over the process of using the shield, and some people will choose to throw it on the floor. But if you were going into battle against the Vikings, would you want a sword and a shield, or just a sword? That is what I'm going to ask you today. And if your answer is just a sword, then by all means go out there, swing your sword, and try to cause as much damage as you can. But I can guarantee you're going to come back with no legs, no arms, and essentially die on the field. Whereas the trader with a shield, yeah, okay, you might take a little nick or a little bump, or you might get caught here or there, but that shield is going to save your life. Yeah, okay, cool, you might lose a finger, you're going to experience some painful moments, but the moral of the story is the shield will save your life so you can fight for another day. And that is the number one rule that I can implement, and the number one thing that I can teach someone who doesn't know how to trade and who is developing how to stay in the game, how to keep your money, how to effectively manage your risk. Because people talk about risk management all the time and then say just trade 1%. Well, what am I meant to do when my account's about to hit max drawdown on my FTMO? What are you meant to do then if you're meant to just trade 1% risk? You need to have adjustable risk for the adjustable scenario, and this scenario, as you go into drawdown, reduces your likelihood of blowing the account. So that is why I want you to all start to implement your shield. Cool, you don't have to stick to this exact model and template, but this is the idea. When you lose, reduce your risk. The same way that I would want you, if you got injured playing a sport, you slowly come back. You don't go from having an ACL injury to going and doing long jump, or going to play a full 90 minutes of football, or implementing a new move in basketball where you're spinning on that knee specifically. You come back, you do your little warm-ups, you get your resistance band and you just ease back into things. You get the joint moving. You start to implement slow and steady paces, and that's what this is doing. When you're down and when you're out bad because you're injured, then you start to recover, and this helps you recover. And that is what I want you to take away from this section of the video. So please implement your shield and make sure you use it. So the next portion of today's lesson is going to be finding your weighing price, aka bias. And this is a thing I feel like a lot of beginner to intermediate term traders struggle with, because they often look at the daily or the 4 hour for their bias, and that's okay intraday. But for long periods of extended bias where we can be bullish for months on end, we have to be looking at a minimum the monthly chart. And then in that sense, we can implement a few skills that I'm going to teach you today to start to accurately pick out which weeks in the month and pick out which days of the weeks that we're going to trade. So we're on NASDAQ on the monthly chart here, and as you can see, I've got a dealing range labeled with this sell side liquidity and this buy side liquidity here, and then we have the greater price swing from this low till this external high. So if we drop our fib tool on that, then we get these levels. So as you can see here, we've got the 25% level, the 50% level, and the 75% level, all in between this section of price. So as we've got equilibrium here, this red line, we have price pushing up in an impulsive expansion swing to the upside, creating a swing high. Price drops down, leaving a fair value gap. This just bumps the high of this candle and then drops. We have a bearish immediate rebalance, and then price forms a swing low at the equilibrium price level. Notice this swing low does not take out this swing low, which creates relative equal lows that are failure swings. This is a large liquidity pool now at this point. This was already a decent sized liquidity pool, but notice just at equilibrium we form another swing low to increase the amount of liquidity that is going to be absorbed when price spends some time at this low. So price creates a mitigation block, and then it drops down into this liquidity pool, and then we'll look at the considerable amount of time price spends. It spends 1 month, 2 months, 3 months, 4 months at equilibrium and in close proximity to this liquidity pool. Now, what we're going to be utilizing once we've established price has spent time in a liquidity pool is a change in the state of delivery. So what that is, we're going to look at the last down close candle in an up move or the last up close candle in a down move, and then we're going to wait for a strong close above this and ideally above the high as well. If you get a close above this but not the high, that's okay, but the ideal scenario, we get a close above the high and a close above the open. As you can see, for 1, 2, 3, 4, 5 consecutive months, no body closes considerably above this opening price. So these are the months we can anticipate to wait, and these are the times you'll be in your trades, and then most days you'll be flipping bias, going from bullish to bearish. But if you just zoomed out and look at the monthly chart, all this time in here you could be waiting because you've not had a change in the state of delivery. Bear in mind, we're in relative discount in the lower half of the Fibonacci, and then we get our change of state of delivery here on this day. So on this month, the 1st of March 2023. After we get that change of state of delivery, noting it closes above the high as well, then we can safely say that price has switched gears. Now, if these weren't relative equal highs and price just dug down in one candle and then closed above this opening price, you may experience some choppier price action. Number one, because it hasn't spent time absorbing this large liquidity pool, and number two, that's going to want to draw price back down back into these equal lows here and absorb more liquidity. But luckily in this case we spent 1, 2, 3, 4, 5 months in close proximity to equilibrium and to the sell side liquidity pool. after we get that change of the state delivery and price has changed gears from offering sell side to offering buy side, imagine like in your car switching gears from being in first gear to then going into reverse. So in here we're in reverse, and then here car gets put into first gear, here boom, we close above the high and above the opening price. Now the next algorithmic signature we see is this immediate rebalance, and that is basically price closing and giving our change in the state of delivery, and then the consecutive month comes down and just bumps the high of this previous candle, creating that 3 candle formation. If I zoom in, these 3 candles in here creates the immediate rebalance. So now we've changed the state of delivery from offering sell side to offering buy side. We have an immediate rebalance showing prices willing and able to go to the upside, and then at that point, once we've changed gears, we can add another little piece of context which really helps solidify how strong this price move is going to be. Now, if you notice below here before, we had fair value gaps in this portion of price. The fair value gap from here to here gets partially filled by this candle's wick, and then later on it gets filled more by this blue candle that sweeps the liquidity below here. So the portion that's left unfilled can be classified as our breakaway gap. Now breakaway gaps are great because this gives us underlying strength in the market. Imagine the market spent time retracing rather than expanding, that would be a more sluggish price run. So all of these fair value gaps down here signaling to us that this is going to be a stronger move to the upside, because after we've spent time at our key level and liquidity pool, we've changed the state of delivery and then immediately rebalanced, giving us a willingness for price to go higher. So now we've understood the fact that we've got a stronger price run because price hasn't spent time retracing and filling in these gaps. It's just spent time consolidating, absorbing liquidity, and then we get the change in the state of delivery and delivering fast price action. As you can see, for these next 1, 2, 3 months, we see expansion candles to the upside. So these breakaway gaps give us that confirmation in a sense that, okay, this price run is going to have energy, and then we can look to utilize some opening prices of the monthly candles to purchase effectively. So once we've established we've got a stronger price run, and then we've got our change in the state of delivery here on this candle, once this candle closes, we need to look for premium targets in this price leg above the 25% level, because we're in a relative discount from equilibrium to high. So this portion, this 25% quadrant, is the lower portion, and then we need to look for PD arrays and liquidity in this portion here. So the only viable liquidity and premium target is this fair value gap in here. Now if you notice, price just comes up here and you see it just bumps the high of this candle. So that creates a swing high liquidity pool in inefficient delivery, which is a double whammy. Imagine a double deal. You're getting the burger and the chips instead of just the burger. So you've got the liquidity within inefficient delivery. So this becomes a strong draw on liquidity for us. And also the astute of you will notice that down here, we had the same thing. We had liquidity in an inefficiency. That became the draw on liquidity and also the reversal point. So just keep those in mind. The breakaway gap draws when you've got liquidity in an inefficiency in this area from this candle's low to this candle's high, then you've got a double whammy, and that's why price draws down into it. You've got these relative equal lows, failure swings, and then inefficient delivery with liquidity in it. So this was a strong draw on liquidity. And then moving through price, once we have the immediate rebalance, we can safely assume that price no longer needs to return into this area of price. So if I just label this, now price, so this orange shaded area, once we get the immediate rebalance, as where price is balanced, we shouldn't expect price returning to this orange shaded area, and if it does, we could assume that the price run higher might be a bit more stagnant than this is. But because this monthly open, it opens, creates the low, high, close, and nothing returns to the balanced area of price, then we can safely assume that this is a stronger price run. So what would make this look like a weaker price run, and a price run where we can't be exceedingly bullish for these consecutive months after? First of all, we only had one dig below this sell side, and we didn't spend any time in close proximity to it. So if we saw a candle like this just close and give our change of the state of delivery here, we've actually spent no time raiding this liquidity pool here, so price might be more willing to come back down. In the same sense that if price came down and filled these gaps completely like this, we would expect a more stagnant price run to the upside. Instead of having expansions like this up, price would just break highs, retrace a large majority, come back like this, and it takes a while. So as you can see, without the breakaway gaps, we've got a much more stagnant price leg with deeper retracements. But because we've got the breakaway gaps confirming that, and we've also got time spent at our key level, we can safely assume that this change of the state of delivery and this immediate rebalance are going to give us energy to the upside towards our draw on liquidity. So if we draw out the opening prices of all of these months consecutive, all of these bullish months, then we're going to take a look at these portions in here. I'll make it blue. So the opening to the low is in a blue shade, and we're going to look for good buying opportunities at, below, or in close proximity to the opening price. So you'll be able to see, once we drop down, we'll drop down to the weekly first. Now on this weekly chart, we have the weekly open here, the monthly open here, and then the low is formed. Then the consecutive week, the 8th of May week, we close above this candle's high, and then this week right here, what do we see again? Like we saw a monthly immediate rebalance, we see a weekly immediate rebalance. And now this is above the open, but how do we determine if we're in close proximity to the open? Well, what I want you to do is to look at the open, look at the low, and then simply move this box from the open up above. So now this classifies as everything in close proximity to the opening price. So this immediate rebalance here is in close proximity to the opening price, so this is a valid buy on the weekly. Okay, this would be more of a position trade, but if you see that on the daily, then you can start to see which days are really good. This isn't clear on the weekly, this isn't clear on the weekly for an entry, so let's drop down to the daily. Doing this all in one run, so you see it's no higgery jiggery. So here we've got the monthly open, and look how we create that order block. Then here we change the state of delivery with this candle. So once we create that, and then we've got another breakaway gap here. Got this breakaway gap, creating a swing low, and then we leave a fair value gap, creating this swing low when this candle closes. And now this breakaway gap can give us the narrative that price doesn't need to return down to here, but now we have entries at this fair value gap, this weekly immediate rebalance. We've also got an entry here on this order block. As you can see around these levels, there's multiple entry points, and you could even caught an entry below opening price here on this day, and then continue to hold till here. And then going through price, we see price create an intermediate term low here. So what that means is, because this order block and this low completely filled this imbalance just there, boom, this candle completely fills this buy side imbalance, sell side inefficiency, we can safely assume again that this low in our buying program does not need to be taken out. It can trade to 50% of this wick, and if we look at this right here. Candle just taps 50% of the wick in the imbalance, and then that was the reaction point higher. So we don't want to see, ideally this wick doesn't even touch the CE, that would signify stronger days. So what does that mean? How do we get bias? After we see this daily candle tap the CE and close bullish, this day we can be bullish as well. We could have bought this CE down here because it's close proximity to the monthly opening price. And then we've got another daily immediate rebalance here, and you can start to see how we're just going through the motion of seeing price print to the upside, all derived from the monthly. We're not looking at the daily, we're getting our daily bias from the monthly. And then continuing through price, we see these expansion days we are all bullish through, and then what happens again? We create a type 2 intermediate swing low. This low here completely fills this imbalance, and then we have a small breakaway gap. So this breakaway gap is formed when, so we don't know this is a breakaway gap until here on this day, this candle creates that swing low and we leave a small portion unfilled by that gap. We've completely filled this upper premium gap, and that creates our type 2 intermediate swing low that should not be traded to and through. Remember, you can use 50% of the wick, that might get traded to, but again, that would be a more stagnant price run. And then we see these 2 days, consecutive days, extremely bullish on this day, on Friday the 26th of March. And then we get into the next month. We see the opening price comes up, takes out the high, price comes back down and trades to the opening price and just misses out on the low. But this rejection block here, which is the opening price, could have been your entry, or if you don't feel comfortable doing that, then your entry could be below this low. And you can see the consecutive days after gapping upwards, reaching towards our overall target. So if we move this to here, then you can see price is drawn back up to that equal highs premium array in the upper quadrant of our dealing range. So we've got entries down here, we've got entries down here, this is on the daily, and this all gives you bias for these 3 or so months coming through price. In the final month, we see price comes up and just fails to fill in that gap completely. So there's a small portion in this portion that's left unfilled on the monthly chart. And then what do? It breaks down after reaching a premium array, and then it comes back down to this actual gap or volume imbalance between Monday and Tuesday's settling price and opening price. And then price comes up, and notice here this high just fails to take this high out. So as you can see here, we have a failure swing. Now in this instance, a failure swing when we are bullish is what we want to see. Price would be problematic if we saw an instance like this, where price, let's say it closed down here and then it opened up and then we made a high like this. That would be problematic because this liquidity has been taken out. Whereas in our actual example, this liquidity here that has just got a small portion of the imbalance unfilled. If you see this portion just here on the monthly, that small portion is just left unfilled. So we've got inefficient delivery, failure swing liquidity, and then what do? We come below opening price and we run a low. That is your go signal. At the same time, we have this candle here. This candle is an order block. This whole 2 candle formation is the order block. So this whole area is a good purchase for buying because we took out liquidity. We've shown willingness to go higher with this fair value gap after the formation of the order block, and then we dig into it and take a low in it. But if you really want to get technical and zoom into where in this order block you want to be a buyer, it's in this wick right here. So this candle's opening price to this candle's high. As you can see, I make that a bright colour, or so yeah, this candle's high to this candle's open creates our purchasing area. We raid a low within that, so that's a strong buy signal. That is a massive buy signal to the trader who is viewing price as I'm showing. And then what do? the day closes way above this low, which is positive. This next day we have a small range, so we've got 3 small ranges in here, and then look what comes after. 3 small ranges after taking a low in this order block, failure swing highs, market maker buy model, and then look, these consecutive days expansion. So this day right here, the 12th of July, fully fills this imbalance completely. There, boom, and it takes these highs. So what gives us the indication that price is going to start to retrace and come lower again? If we just delete some of these, areas just to clean up the chart a bit. So as you can see, that was on the daily, how many days we get a bullish bias for. So if we look back on this monthly chart, we start to see, obviously this is a range in itself of 43% of the price run, so that's 5,000 points of price. So that's a huge range in price, 5,000 points. And then we see from 11,000 to 16k. This was the portion I was showing you to be bullish at, and then once we reached our premium target here, boom, and this month, as you can see, this portion in here, that was the portion that just failed to fill that in, that small area there, and then price comes up. How do we know that we're going to get a retracement here? Well, as you saw me do with this price run from this low to this high, that's even more of a price run. That's 10,000 points. This 5,000 points from the equilibrium to the high, we can break down into quadrants again. So if we just do that, I'll place the fib on here and then onto here, and then we drop down to the weekly, and we can see once we bump this high, look what we dig into on the weekly, just this fair value gap. Then this fair value gap, after the fair value gap, from here to here, we leave a breakaway gap. So this breakaway gap, this small portion, price bumped above this high and left this portion unfilled. Then what happens? We change the state of delivery again. So that validates our breakaway gap logic, and we can anticipate that price is going to retrace for a while. So this retracement into here, and then we come back up into this valid order block, and then we come lower, take out some sell side liquidity, again retrace until a full fill of this imbalance in here. So this candle here fully fills the imbalance, and then we come down and we take out this liquidity below here. So if we look on the daily, what price is doing a bit more intimately, we see again liquidity in an imbalance. What does price do? Draws up to it. Then because we're bearish, we use this bearish order block here, and then price expands lower into this liquidity, and then it's just doing shallow runs below liquidity. Like I told you, when price just does a shallow run below liquidity, it's still making relatively equal lows. So we've got relatively equal lows below the marketplace, and if you look a bit further right, we've got some more relatively equal lows resting inside of a BIAS imbalance. And now look what price does. We've made quarters. So this is the quadrants of our upper 2 quadrants. Price within that section runs up, meets the premium targets, just here, boom, just taps it, leaving that breakaway gap, and then we start to break lower, create equal lows, fill this type 2 intermediate term high. Remember that when we're in a sell program like we are here and all the way through here, price should not break that. So when price breaks that here, that's significant for more upside, and we can be extremely confident that our external high is going to be taken. But going back to the breakaway gap draw, we've got these equal lows and then these equal lows that sit within this imbalance. Price comes back down, takes liquidity and just digs below equilibrium of the upper two quadrants. So that creates a relative discount on the daily, even though some people who just see ICT as a dealing range from here to here will say we're in a premium. This range needs to be broken down into multiple layers because it's a 5,000 point range. So if you're looking within that range just with one dealing range, you're going to be blind. So price meets our premium targets here and here, creates equal lows, creates an intermediate term high type 2, and then breaks down to a breakaway gap draw with liquidity in an inefficiency. Further along here, we're expanding higher, reversal signs, and then boom, this candle closes strongly above here, this type 2 intermediate term high on the daily. So what that's telling us is this price runs strong. There is no reason for us to be in a mindset that this is still a sell program here. We were just finding short-term discount, raiding sell stops for the second stage of distribution. And as you can see, price continues higher and higher, meets that premium target again, has a small consolidation and retracement into what? Liquidity resting in an inefficiency. You see them everywhere, people. If you're not recognizing them or implementing them, then you're clearly neglecting something that is extremely apparent in these markets. If we just drag our breakaway gap draw whilst we're bullish, so from down here we know boom, we've closed above the type 2 intermediate term high after coming into a discounted market, raiding all the sell side liquidity. What's the next port of call? The buy side of liquidity. Low resistance liquidity here, failure swings along this portion of price, trendline liquidity, whatever you want to call it. And then what do we have? We've got, again, if we just go back to the weekly and we just drag this to here, so we're labeling the full imbalance now. What do we have? We've got the liquidity in an inefficiency once again. So this breakaway gap draw, where it was previously used here with our change of state delivery to confirm this was a breakaway gap from this candle's high to that candle's low, as that was used here, once we raid enough sell side, that becomes the drawn liquidity because we've got the liquidity inefficiency. And then look what we do. We draw towards that here, boom, take that out, consolidate as we've met a large liquidity pool target, and this was external range liquidity to this fractal of price. So we spend time consolidating, absorbing that buy side, then we dip back down to liquidity and inefficiency once again, and then we leave this portion left unfilled. So that gives us another breakaway gap. And then we finally meet our draw here on the 13th of December 2023, and that is how you can read through and find your way through price. There's lots of things to take in there, so if you need to rewatch the video, just do that. It's not extremely complicated. I'm just looking at the processes price is following. As you can see, we've broke down this upper half into 4 quadrants, and then as you can see the relationships here of price coming off the lower quadrant, back up, back down to the lower quadrant, and then higher. And if you really wanted to take it deeper, you can split up these quadrants, so you would do from here to here, and now you've got these more intimate quadrants in here, and then you can break price down using those swings. So what I want you to take from today is buying at or close proximity to opening price, looking for breakaway gap drawn liquidities because they're extremely powerful, grading longer term price swings on the monthly, spending time at your key level and liquidity gives you confidence that you do not need to return down here, especially after changing the state of delivery. And then we also need to look at the monthly opening price and then look for things within close proximity to the monthly open. So again, we do that. Let me just show you again. We were looking at this month. So if we just draw the opening price, if we don't know if we're in close proximity to the opening price, we do it on the daily actually. So if we don't know, right, okay, we're here, we see this opening price, here, and then we're unsure if this is a good buy or we're in close enough proximity, like prices ran away. We see that this low formed the order block, then we change the state of delivery here when we close above this high, then we get a breakaway gap confirmed with this swing low when this candle closes. So we've got a swing low leaving a portion of the FVG unfilled, which is that breakaway gap. The opening price is the opening price of a bullish order block, and then we return creating a type 2 intermediate term high. So we've done a lot of price algorithmic delivery in this portion, but then we see price break away from us. We're still bullish, so how do we know if we can be confident with our purchase that we're not too high in a premium? So we're going to drag from the open till the low. We know that price shouldn't come below this low here, so we can drag this low up to here, and then look what we get. This fair value gap lines perfectly, so this is a good buy, and then you can hold it all the way through till our bullish targets. And that is how you know if you're in close proximity to the opening price. Project the low above the open, and then the open, or if you're bearish, project the high above the open, and then you'll be able to look for PD arrays within close proximity and then figure out if you're safe to buy in those areas. So I hope you can implement these skills, and rewatch this if you felt I went a bit quickly because there was a lot to take in there. But implement as much as you can into your own price reading, and remember to use the monthly and zoom out. Too many times I see traders looking at the daily for their daily bias, but without an idea of where the macro draw on liquidity is. That can get you burnt because you don't know when price is going to stagnate, aka these areas here, when it's spending time at liquidity and failed to change the state of delivery here. So all these 1, 2, 3, 4, 5 consecutive months were all bad trading months, because we understand that price is spending time in our liquidity area, these relative equal lows, and then we haven't changed the state of delivery yet, so we've not gone into a buying program. This is purely absorbing sell side liquidity and building in positions by smart money for this run higher retracement, and look how that retracement just drops to the upper quadrant, and then we expand to the external liquidity. So remembering waiting for those changes of state deliveries to confirm your breakaway gaps and any other PD array that you use, and then immediate rebalance. Again, another little trick that you can use with this. After this third candle closes and forms, these two next candles need to show a willingness to go higher. If this candle closes like here, and then this next candle closes strong, okay, we're okay. But if this next candle closes below this candle's opening price, and the one after that closes here, then we're more than likely coming back to these equal lows and these inefficiencies. But in this case, we get the close here, forming the immediate rebalance, and then the next two candles are showing us that willingness to go higher, so we can start to look at buying at the open, close proximity to the open and below the open. So yes, there was a lot to get through and a lot to implement into your trading, but these are all skills that will make you rich. So if you really want to make this happen, please rewatch the video and make sure you've taken notes. Thank you for tuning into this video. I hope you can implement these skills straight into your trading and improve as much as possible. Please drop a like and subscribe, and comment down below what you want to see next, or what you have managed to take away that has helped your trading in the video, and I'll catch you later, people.